So welcome everybody to the Be the Sniper or Be the Target webinar series. My name is John Skelton with apexinvesting.com. And as always, we've got to kick it off by showing some disclosures here. Trading involves risk. Make sure you know what you're doing before you do it. Who all was with us last week? Last week I did kind of a beginner's webinar. You know, some of you that are veterans stayed on because you wanted to recover some of that. You know, like I said, we've got quite a few new members with us, and I've seen a lot of confusion about divergence and hidden divergence. So I wanted to kind of help clarify that a little bit. Did you guys find that helpful at all this week? Have you been able to use it at all since the webinar last week in your trading? And like we talked about, I gave you a lot of visualizations last week to keep in the back of your mind as you're looking for divergence. And so I hope that you've been able to use that, and I hope that that's been productive for you. Yes, if you go to the Apex website here, okay, and you go right here under the Sniper Bootcamp, click that. He's asking where to find the recording from last week. So what you do is just scroll down. Once you get to the bootcamp page, you scroll down to section 8 right here under webinars and just click that. Okay, and that's where the webinar recordings are. All right. I'm sure you guys have seen this blasted everywhere and you've seen it talked about in the rooms. But tick strike as well. If you guys, I think we've got it on the homepage now. Where's that? If you guys have not taken advantage of tick strike, definitely check it out. I know a lot of you have. I know a lot of you have seen it everywhere. I'm not going to spend a lot of time on it, but I know it's been extremely helpful for a lot of people. So make sure to check out this video as well if you do not have tick strike. But that's where you can find the recordings. That's where you can find tick strike. Tonight's recording will be in the same spot. Okay. As you guys know, normally on the holidays, we do some specials. We've got Labor Day coming up. I'll get out some Labor Day specials. Normally we do, you know, some monthly or 4-month, 6-month, 9-month, annuals, lifetimes. I know several of you have asked, hey, are there any specials coming up soon? I'll get some out to you this weekend. Do you guys want me just to pop out some membership specials, or do y'all want some specials on some of the mastery courses as well, like Thrive or Mind Mastery? Or you guys tell me what y'all want and I'll put that out there for you. Okay, because I know I've had several requests for some things. Maybe I'll just pop a bunch of stuff out there. The one thing I will tell you is this: for those of you that have gotten tick strike, and you've seen how much that really helps you with the market reading, if you do not have Thrive, I would definitely suggest that being the next thing. Like, if you really want to take your trading to the next level, just in general, you definitely got to go through the Thrive course. But if you have added on tick strike, if you can see the whole picture and have tick strike and what we teach in Thrive, it's just a completely different world. Okay, so out of anything out there, I'm going to recommend Thrive and Mind Mastery. But I'll get a few things up, posted out over the weekend. You guys can check out what you want there. Okay. So again, welcome to new members. We've got a lot of them. Tonight we're going to be reviewing some basics. Like I said, we covered divergence last week. I showed you where that recording was. Got ahead of myself there. Tonight we're going to be talking about hidden divergence. Okay. So we've got divergence and hidden divergence. I know a lot of you have already gone through and watched the basic training videos of both of those, but I know they're easy to confuse, right? And to get mixed up. So that's what this is about. So last week we did divergence. I just want to do a quick, like 5 minutes here, just a quick review of last week. So we kind of set that foundation again of, okay, this is divergence. Make sure we reestablish that. Now let's dig into hidden divergence, okay? Because they're the exact opposites. So I want to just kind of nail it in stone here. All right, so like we talked about last week, and again, if you missed it, you can check out the recording. Standard divergence is when the price of an asset is moving in opposition to momentum or volume. We talked a lot about how it's It's running out of steam. That trend could almost, almost be done or over, or it could take a pause. And I've always taught divergence as a marathon or running up a hill. You're running up a mountain and you're losing steam. You're getting further and further and further up the mountain. You're going further up in one direction, but you're losing steam the further you go. And at some point, you're not going to be able to go anymore. And I really kind of instilled in you last week some of these pictures, some of these analogies of people running uphill. They're making progress. They're going up the hill. They're putting in a lot of effort, and they're going to get further and take a little breather and further and take a little breather. They keep going higher, but they're losing steam, and eventually they're just going to give out and have nothing left. We're not talking about a flat market, a flat walking, hiking trail. We're talking about effort, momentum, clearly an incline, clearly upward or clearly downward momentum, okay? That at some point is going to run out of steam. And that's what I told you to visualize in your head as some of these pictures. Not this, though. This is not an incline or a decline. This is not momentum that's going to run out, going higher and higher or lower and lower. This is just a flat walking path where people could go all day long, right? We're not looking for that. We're looking for a clear trend up or clear trend down, and we're trying to see when that clear trend could potentially run out of steam. We're not looking for the markets to be between 9 and 3 just wiggling here. We're looking for a clear trend up like to the 130 or a clear trend down to the 430, because we want to see that clear trend, that clear steep incline, and get an idea of when it could run out of steam. Doesn't always mean that it'll reverse and go hundreds of ticks the other way, but we want to see when the energy is running out. And this was the best analogy here, right? Remember I named him Marion's boyfriend here, right? The half-naked dude pushing the boulder up the hill. He's going, he's getting further, he's making progress up, but at some point he's going to get worn out, right? And at some point, you're going to see those arms start to shake, those legs start to shake. And he's not going to be able to get up any further. In fact, he's going to barely be able to hold on to where he is. He's shaking and shaking. He's losing it as he goes. And you want to be able to see that and spot that tiredness, because when he gives out, it's just going to tumble. Okay? Yeah, Marion, exactly. It's going to tumble and tumble down the hill. Okay? So that's divergence. And we made it very clear that we want a clear trend, right? Not a maybe trend, not a questionable trend. Is there anything questionable about this incline? No, it's very clear it's going up. There's momentum and power behind it that could give out and will give out at some point. So standard divergence, we're looking for a trend, whether it's an uptrend or downtrend, and we're looking for it to be potentially burning out, wearing out, exhausting, ending. Okay? So we've all got that in our heads, right? Because we want to see that momentum fail, and we want to see it fall enough back down the hill or up the hill in order for us to get our profit out of it. Okay? And we went through some examples, right? Market coming down, 975 is the strength there. Comes down even further, 2350. Comes down even further, but only 1751. We see that drop in volume, right? We see that the market actually went further, but it lost steam and it gets rejected here. Okay? So we went over multiple examples of that. Okay? How the market comes up, 817 comes up, 1780 comes up, 1658, and then goes even further, and like the volume dropped in half. We can see that, right? We can see that exhaustion when that trend is potentially coming to an end or going to pause. So that's divergence, standard divergence. Okay? Standard divergence, running out of steam, almost done or over, running up a hill. And we don't want to go against the trend when it has strength, right? When a trend has strength behind it, we want to go with the trend. But when we see that trend running out of strength, that's the time we would look to go against it. All right, so everybody's got that. Standard divergence is when the trend could be ending. Hidden divergence is the exact opposite, okay? We're not looking for that trend to be running out of steam. What hidden divergence is showing us is the possibility for that trend continuing, okay? So standard divergence is exhaustion coming to an end. Hidden divergence is looking for a potential continuation in the same direction of that trend. It's where we're looking for some type of confirmation of potential strength to keep going. Does everybody understand that? Like that's the biggest that's the simplest way I can put it, and the biggest thing you have to remember is the differences there, okay? Now again, both of these are only used in clear, plain, without a question, without a doubt, trending markets, okay? If you missed last week's webinar, watch the recording. We went through a certain section there where I pulled up a chart and we used some examples, right? Of where it'd be easy for you to try to find divergence or try to find that it was a trend, or you're being technical about it being a trend. You want it to be just clear as day, okay? Clear as day. If in doubt, finish the sentence. If in doubt, stay out, right? Okay, so don't get confused. Now, here's another big thing, and I'll show you some examples. We're only comparing the current trend to the current trend, all right? The new trend direction must be clearly established, and we need at least one pullback already in the trend to compare to. And again, I'll show you examples, okay? So let's back up here and do what we did last week, but I'm not going to have near as many examples to show you here, okay? Because I think you get the idea, and I don't mean to break things down so elementary, but I think if you just keep some of these images in your head, like Marion does with her boyfriend picture there, I think it helps you as you're watching charts every morning in the elite room, right? And you can, is this divergence? Do I see them running up the hill? Do I see that guy pushing the boulder? Do I see it wearing out? I think it's important to have some of these. So slingshot, basic little slingshot. Is that slingshot pulled back very far? This guy lets go of this slingshot. That rock's going to go, but how far is it going to go? Yeah, not real far, right? I mean, it's pulled back. There's some tension on it. He lets it go. It's going to go. But is that something that excites you? Like if you equate that to the market, as far as like how far that's going to go? Yeah, it's going to just go through here and fall on his foot, right? That's not something that really excites you to get behind. Okay? So when you think about it in that term, how far is this thing going to go? You see the difference there? I don't know what the heck that guy's got there, but that sucker's going to go, right? Like, do you see the difference there? Yeah, I want one too, Chris. Yeah, that thing's going to go to the moon. Okay? So very cheesy, basic, elementary examples there. But it makes sense, right? If you just kept those two examples in your head, you probably got it. That's the difference of that pullback. What's behind it to let it go? That sucker's going. I don't want to be on the other side of that, right? That's Marion's ex-boyfriend right there. She got rid of him because all he did was play with his slingshots outside. Okay? Does that make sense already? The pullbacks. How big of a pullback? What kind of strength is in the pullback? What kind of momentum is in the pullback? Okay? When you equate that to a market, that's something I can get more excited about getting behind, right? that movement of the market compared to the previous screenshot, okay, hey, that might be something I want to get, be a part of. Okay. Yeah, Jeff, I would if I could. So keep that in the back of your mind. It's no different than a bow and arrow, right? I don't know why he's playing with this little kid bow and arrow, but that thing, that arrow is going to go a little ways, right? Not real far, and with the little suction cup thing indoors, yeah. It's got some tension behind it. It's going to go when he lets go of it. It's not going to be anything to speak of, though, right? Not going to be anything exciting. Nothing too crazy. Or this little kid here. He's having fun with his little targets. He's got his little kid bow. It's going to go, but, I'm not seeing a huge amount of strength, momentum behind it. I'm not necessarily saying I want to get behind that. But I have a lot of faith or confidence in that. Okay? And so again, now compared to this guy using this super inverted compound bow. That sucker's going, right? Yeah, now we're talking, Chris, right? Okay, you guys get the difference? You guys get it? I know some of you are like, okay, John, move on. We get it. Like, we don't need to see any more of these little pictures. But if you keep these things in the back of your mind, just like you keep the ones from last week of running up the hill or pushing the boulder up the hill, it'll always stick with you. And when you're looking at that chart, you know how to think about that. Okay? And you know how to think about, is this really hidden divergence? Okay? Is it hidden divergence? So let's move on. Keep those pictures in your head. Keep those analogies in your head. Let's look at a couple charts here. If I can just get my dang screen to move. Okay. So, basic chart here. What's going on over here on the left side? Coming down, we pull up. Coming down, pull up, coming down. This is like the end of a downtrend here, right? Okay. What do we have clearly here? Is the clock between 9 and 3, or is the clock like at 1:30? We're in an uptrend. Okay. And we all know that most of the time, 90-something% of the time, with an uptrend, it doesn't just go from point A straight to point B, right? What happens is it pulls up and then it comes down. Pulls higher up, pulls down. Comes higher up, pulls down. Higher up, pulls down. Higher up, pulls down. Higher up. That's a trend. We all know that, right? So last week, let's talk about an uptrend, okay? I'll talk about some big key things here where people get confused. In an uptrend with standard divergence that we covered last week, we're wanting that market to go up, 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 and run out of steam, right? So what number are we looking at? On the oscillation detector, we've got numbers up top and numbers up bottom, right? The number up top is measuring this push up, and it gives it a level, a gauge. This pullback down is measured here. This push up is measured here. Pull back down, measured here, right? So with standard divergence, where we're looking for a trend up, for example, we want to see when that momentum going up runs out of steam, right? So in an uptrend for standard divergence, like we talked about last week, we're looking at the top numbers. Everybody understand that? For standard divergence, to see when it's running out of steam, we're not worried about the strength of the pullbacks, right? We're looking at the strength pushing up to see when it gets exhausted. For hidden divergence in an uptrend, we want to measure the strength of the pullbacks on the bottom. Obviously, this would be inverted for a downtrend, right? So does that make sense? Just that right there, because if you don't get that part right there, you'll always get confused about divergence and hidden divergence. So to measure in an uptrend, to measure the strength of when it runs out, we're looking at the top numbers that are pushing up. For hidden divergence, which gives us a potential continuation, we're looking for the pullbacks. Okay? Because remember, that's how a trend works, right? Goes up, pulls back. Goes up, pulls back. Goes up, pulls back. Goes up, pulls back. Notice when I say the term pulls back. Ah, got it? Now you know why I use those picture examples. Pulling back a slingshot. Pulling back a bow and arrow. Okay, see that connection there mentally? Okay, that's why I say these seem cheesy and elementary, but if you remember these pullbacks, okay, that hidden divergence based on the pullback, pulling back the bow, pulling back the slingshot. Regular divergence is based on the push up, the guy pushing the boulder up. Okay, see why you want to keep that in mind? So now when we talk about the difference of the small bow and arrow being pulled back compared to this big one, now let's look. Okay, so what do we know about these percentage numbers here? What this is saying, okay, is that this pullback in the market right here was 749. That's 280% more than the last pullback, right? So then the market goes up, then it makes another pullback. What was this pullback? 1,071. So it was even bigger than this one. Does everybody see that? So that's what hidden divergence is what we're looking for is a clear trend, a pullback in the trend that is bigger than the last pullback. But it didn't pull back as far. Does that make sense? So let's look here. What am I? Oh. So right here, when it made this pullback, the pullback was 749. Okay, and it pulled back to right here. The next time it pulled back with a lot more strength, right? 1071. But even with more strength, it did not pull back to the same level. That makes sense? Do you see how this is the opposite of standard divergence? So basically, it's less on more, meaning it made less of a pullback, but on more strength. See, standard divergence, we want it to go higher, right? We want it to go more on less volume, right? We want it to go further in price, but less volume to show exhaustion. Hidden divergence, the pullback, is where there was more strength pulling back, but even with more strength to the downside, it could not get as far low as the previous low. Does that make sense? Yeah? Okay. So that's what we're looking for with hidden divergence, is a pullback against the trend with a lot of strength, more strength than the last pullback, But even with more strength, they couldn't even get it back to that point, right? What does that mean? It means like rejection, right? It's an uptrend. Sellers are, hey, we want to pull it down. Oh, we couldn't do it. When this next time, we're going to try to pull it down with even more strength. Boom, boom, boom. Even on more strength, we couldn't get it back down to the same place. So with that push down and that fight, rejection, boom, like that bow and arrow. Make sense? Also, we'll talk about it in a minute, but do you see all these little icons right here? That's another way of spotting hidden divergence. Okay, it's not part of the oscillation detector. It's a couple other back-end detector indicators that are apex indicators that are plotted right on the chart for you. They look at volume, they measure volume a little bit differently. That way you get a couple different views of it. So if you're looking at a trend, okay, I see a trend, I see a trend. Oh, those things are popping up. So those particular indicators are saying, hey, currently we're in a state of hidden divergence. I also see it right here, and you happen to get a reversal bar with a sniper set up, boom. Okay. Yeah, Ron, sometimes you might not see these icons pop up because that particular calculation is not showing hidden divergence, but the oscillation detector shows it because they measure differently. Make sense? When you have them both like that, and then you get a reversal bar right here with a sniper trade on it, yeah, thank you. Right? Okay. So does that make a little more sense of why? Okay, so who said it here? Jeff said, yeah. Okay, remember I talked about, hey, market's going up. Here, tried to push it down. Got rejected. When he went more up. Here, they tried even harder to push it down, right? Got rejected. So a couple people said, hey, that means the overall market isn't ready. Hey, the sellers were trying to take over, but they can't. So if even with all that pressure to go down, and it came in with a lot more pressure than the last time, but couldn't even get down to the same price as last time, and it turns around, do you see how that means there's a good high probability of, right? Because it's just not ready. So do you understand why hidden divergence is a potential continuation trade? Hidden divergence is showing you a potential continuation of the trend direction. Does that help clarify it at all? Of why? I don't like just telling you, oh, here's what this means. I like you to understand the why. Because if you understand why, then you can see it. You can get it. You can understand it. You can read the market. You know what I mean? But that's why it's potentially a continuation trade. Do you also see how and why it's the exact opposite of standard divergence? Standard divergence, we're looking to see exhaustion in the trend. So we can potentially go the other way. Hidden divergence, we want to see that pullback, get rejected, and slingshot off. Okay? Does that make sense? Let me just look at a couple of your questions here. So in OD, you look at the percentage. Yeah, I mean, you can look at the percentage. You want it to be at least 20% higher. Okay. I personally like it to be a lot higher. I mean, like right here. This was 281% stronger pullback than the last one. And that gets rejected. I like to see that. It's 143% bigger. I like to see that. I don't want it being close to the same, but just barely more. You know what I mean? That makes me think of that small bow and arrow. Like I want to see a big, clear, big difference strength. You know what I'm saying? I want to see that big bow and arrow, not the little one, if that helps you. Again, don't get so caught up. I talked about this last week of, well, technically this was more, but just a little more. But technically it was, so it's technically hidden divergence. You want it to be a good size difference where you picture in your mind that big bow being pulled back. Not, that kid pulled it back a little, it might go a little. No, you want to see it. It should slap you in the face, right? Yeah, like 125% is the minimum according to the rule. Okay? Do I like 143 better or 281? Yeah, absolutely. Okay. I mean, you can also see, no, it's live. Yoko, you can see it live. Okay. Another good sell for tick strike. Jeff said another good sell for tick strike. If it's coming down with HD, normally Apple and Microsoft start screaming green. It's an extra confirmation about to turn back up. Exactly. Okay. Exactly. And Daryl and I were just talking about that the other day about how great tick strike helps you see divergence and hidden divergence. Okay. What Jeff's trying to say is when you see this mark going up, 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 you see this big pullback here. And then after it starts getting into right here, that tick strike starts popping green. That's an extra confirmation of, hey, there's rejection coming in on these sellers and the buyers are popping back in. This thing shot up with it. Make sense? Okay. Okay. Yes, Mark, let me try to cover that here in just a second. Okay. That's a good point. Okay. So let's look at a downtrend. All right. Because it's the same thing. It's so easy to understand an uptrend scenario or visual examples. It's the same thing in a downtrend. Okay. As this market's pulling down, obviously it comes down, it pulls up right here on 175. Comes down even further, pulls back up on 780. That's 446% more volume coming in, more fight against this trend. And even at 400% more, it could only get to right here. Okay? It couldn't even get back as high as this last level. Okay? And you see what happened. Now, here's where, you know what? I'm going to get rid of this. Let's just pull over this chart here. Okay. Anybody spot hidden divergence right now on this chart that I just pulled up? Is it pretty clear? This was, I think, yesterday. But yeah, so this market pushes up and it pulls back. Pushes up higher, clearly trending, pulls back. This pulled back 1,200% more volume. So when this market pushed up and it pulled back to here, price was right here. So when the sellers came in 1,200% stronger, they couldn't even get it back down to the same price level. Does that make sense? Then it rejects and goes back up. That's hidden divergence. Okay? Pretty clear there? Now, let me show you. Now, Jeff, I don't count the 1 bars, no. To make it easy, only count it when it plots a number. Didn't plot a number, don't count it. Okay. Now, here's where so many people, okay, is this an uptrend? Is there any question that's an uptrend? Okay. This pullback right here. So this pullback was 71.64. This pullback was 11,000. So this pullback was 163% more of a pullback. Does everybody see that? No question about it. This pullback had more strength in it, right? Is that hidden divergence? Right there. Everybody answer. Is that hidden divergence? Absolutely not. Most of you got it right. A few of you got it wrong. That is absolutely not hidden divergence. Why? This pulled back on 71.64 volume, right? This one pulled back on 11,000. It went further on more volume. That makes sense, doesn't it? Something going further because it had more strength makes sense, doesn't it? Just logical sense. That's convergence, right? Going further because there was more strength is convergence. Makes sense. What doesn't make sense is when the price movement and the strength do the opposite thing. It's not hidden divergence because it pulled back further. This right here is where 90% of confusion comes in with hidden divergence. Okay? Look here. Market comes up, pulls back to right here. Right? Then it goes up even further, then it pulls back. Look at the strength of the pullback. 600% more strength of pullback. But this low is higher than this low. Does that make sense? So it pulled back on more strength, but it did not go as low. Market comes up higher, pulls back to here. Market comes back higher, pulls back to here. Market goes up, pulls further back. That's not hidden divergence. Hidden divergence has to be a pullback with more strength, but it doesn't go as far. Here's another example. This pull, okay, now we're in a downtrend. Market comes down, pulls up, goes further down, pulls up, goes further down, pulls up. So this pull up right here is at 74.82. Compared to this pullback, it's only 14.60. So this pullback is 512% stronger of a pullback. Is that hidden divergence though? Look at this pullback to here. Look at this pullback to here. It's not. Everybody get that now? Everybody see that? That's one of the biggest confusions that I see with hidden divergence. It's the same thing with regular divergence. You get so focused on just looking at these numbers, right? That's where the confusion comes in, right? Because you're just comparing one number to the last number because that's the indicator. It's right in front of your face. It pops up to your eye. It's understandable, right? Okay. Brian, what's your question here? Is it not HD because it didn't set a lower high? Correct. Correct. This one right here, you mean, Brian? Yeah, because what we're comparing it to is over here. It looks like this one went like a tick higher. See what I mean there? We want it to be more strength, but not go as far as the last pullback. So we're comparing pullbacks to pullbacks. We want a pullback to have more strength than the last one, but not go as far as the last one. Okay? So like let's see here, we're moving up, right? Okay? Market comes up, pulls down, comes up, pulls down, comes up, pulls down. This pullback, 17,000 compared to 23,000, so 135% more. It's very easy when you're in the heat of battle, heat of trading, heat of watching your chart to see, oh, we're in an uptrend, we're in an uptrend, it pulled back, oh, 135%. This is hidden divergence. Now, granted, that market went. But is that hidden divergence just because this number is bigger than this number? When you compare this pullback to this pullback, no, because see, it pulled further down. Does that make sense? What about the pullback before? See, this market came up and it pulled back on 89.72. Then it went up higher and it pulls back on 17,000. Almost 200%. Did this pullback in price action go further than the last pullback? No, it's higher. So even on twice the push back, it couldn't get to the same. So is that hidden divergence right there? It is, right? That's hidden divergence. We see it. It's 198% bigger. But this next one that's even bigger is not hidden divergence because it pulled back further. Does that make sense? Does that help? I know I've seen a few of you say, "Oh, wow, now I got it," or "Oh, I learned something." Do you see the reason why? And you see how it's so easy to, in the heat of battle, quickly just think, "Oh, I see the number." Ah, but it wasn't. And here's why. Okay. Now, one other thing. And let's see here. Sean is asking this one, Sean. You're saying was this, so this one here, this pullback was 158% of this pullback. Is that what you're asking about? Um, personally, I guess technically you could say yes. Okay, Sean. The reason I don't like it is because, like, if we look back here, it looks like the market came up, pulled down, then it came up, it made a higher high, right? So it looks like we're trending. Everybody agree at this point? Looks like, hey, comes up, pulls down, comes up higher. Looks like we're starting to make an uptrend. Pulls back down, starts to come back up, but it didn't make a higher high here. Like it didn't confirm right here that we're still making higher highs to prove an uptrend. It pulled up to here and then it came back here. Then it made a higher high. Okay, does that make sense? And then yes, once it made this higher high and made this pullback, if I compare this pullback to this one, obviously this one had more strength. I personally would not take that trade as an HD trade, or I would not consider that HD at that point in time, because this kind of throws off like, are we really in an uptrend? But when this new higher high is made, okay, then it pulls back. Then it makes another higher high. Now I'm looking to compare this pullback to this one. Does that make sense, Sean? Can you understand why? And then, Sean, that brings up, am I saying your name right, Shuan? Shuan? That brings up another good point. Here's the second thing that always confuses people. And Sean just said it. He said, okay, so it needs to be on the second pullback of a trend. Ding, 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 winner. Yes. That is one of the biggest things people get confused about. Because, and do you understand why now? Because I want to see clearly a trend with a pullback and then higher high than this pullback. I need something to compare it to in that same trend. I can't say this is stronger or weaker than the last one if there wasn't a last one. Let me find a better example, because this is super, super important. Okay. So right here, this market comes up and pulls back. This pullback, okay? Should I be comparing this pullback to this last pullback here? Take a good look at this. This is a pretty good example. This is where a ton of people get mixed up. Okay. This pullback is not a pullback, is it? Because it's part of a downtrend, right? Where's the trend going? The trend's going down. Everybody see that? The trend's going down. These red bars are not a pullback. They're a push forward. They're a push in the trend direction. In this area, the pullbacks are actually the upside pullbacks, upside pullbacks, upside pullbacks, right? So past this point, the market comes up, has a little elevator, comes up, makes a pull down, goes higher. Oh, now we're in an uptrend, right? And in this new uptrend, this first pullback, what do we have to compare that to say, oh, this pullback is stronger than the last one, or this pullback's weaker than the last one? Which last one? Is anyone confused right now? If you are, tell me, because this right here is one of the biggest problems I've seen as to where you'll get bit. Does that make sense? This is going down. Now we reverse directions, up, little pullback, up, little pullback. Okay, now we're clearly in an uptrend. We have our first pullback that sets the stage. This is the standard. This is what we're measuring against. But we have to set a new standard. We have to set a new trend direction with one pullback, then keep going. Now we have something to compare to. What happens on this next pullback? Boom, almost 1,300% more volume. But this pullback did not go as far down as the last pullback in price. Is that HD? I think we already talked about this one, but heck yeah. So does that make sense? The first pullback in a trend does not count as hidden divergence, because what you're wanting to do is compare the next pullbacks in that same trend against the previous pullback in that same trend. It does you no good to compare this pullback to anything in a downtrend, right? They're completely separate. Does that help clear it up for anyone? Or any light bulbs going off? Or is anything clearer? Or, oh, got it. That's the part I always missed. I didn't get that part. I was just looking at number compared to number. Does that help anyone at all? Hiron says we always need two pullbacks for divergence and hidden divergence, right? Well, Hiron, you need two pullbacks for hidden divergence. You need two pushes for regular divergence, right? Meaning market goes up, pulls down, goes up higher on less volume than you'd have standard divergence. Make sense? Okay. But yes, I think you just didn't say it the way you meant it, but you've got it. Yeah. Yeah. Yep. Yeah, Ted, like this push down here, right? Market's coming down, pulls up, comes down, pulls up, comes down, pulls up, comes down, and then pulls up right there. 419%. Bigger pullback up, pull back in the bow, right? It didn't go as high as the last pull up, so yep, there's hidden divergence right there in the down push as well. Okay. No, no, Sean. I'm sorry. No, I was just explaining something to was it Ted? No, this is not divergence. Okay, because see, this push up was 5,500, went even higher on more, 8,900, even higher on more, 32,000. So there was no standard divergence in this trend up. I was just saying, had there been, he would need to have two legs up, as it were. Okay. So helpful, guys. Makes sense? Okay. Again, does it make a little more sense now? Some of these cheesy pictures I show you, the guy pushing the boulder up the hill, getting worn out, or pulling back the slingshot, or pulling back the bow. The bigger the pullback that gets rejected, doesn't go as far, could mean the further the push up, right? Okay. Okay. So let's address something here. I don't want to go too long, but I think Mark asked about it. So let's see here. In this trend right here, market pushes up 39,000, makes a pullback, goes higher only on 15,000. So meaning the strength in this push, pullback, the strength in this push was only 39% of this push here. What is that telling you? Just in general, if all you could see was that right there, would you think, I mean, without seeing these, right bar, you would see divergence. You would see potential exhaustion, right? So if you saw that potential exhaustion going up, and you had a bar or two come down. Then you had a reversal bar go up with a sniper trade to go long. Would you take that trade long? Sorry, lost audio. Because, yeah, the reason you would be hesitant, like I said, forget these numbers here. The reason you'd be hesitant to put your live money on the line to buy here to go up, to go long, is because you already saw the market go up, pull back, go up even more, and it lost 61% of its strength, right? I mean, just think about that logically. If I see a market going up and it lost 61% of its strength, do I want to put my live money on the line that it's going to keep going? Probably not, right? Okay. So in general, that is our rule. After we see divergence, like in an uptrend, for example, we're not going to just take any next random long trade right after that, are we? The very next one. Because it's not a high probability. It's possible, but it's not probable, right? Does that make sense? Everybody follow me? It's very important. Mark, I think I already answered your, I think you already got the answer, right? But what happens when I see, because what is my fear right here? Ooh, this uptrend could be over, right? Ooh, it hit some resistance. It might be exhausted. This push might be over. Market might be going down, right? Right? I mean, that's our concern. But then I see this. Oh, it pulled back here on 2032. Now it came in and pulled back at 12,000. 600% more came in and got rejected. The market said, nope. So then I say, it's not over. Can I then go long? And do you see why? See, this is what I hate. Or I shouldn't say I hate it, but it's one thing in the basic training when we're teaching you the rules, right? Well, if you see an ODD, don't take the very next long. But you can take it if there's HD after that. And you're like, what the hell is John and Daryl talking about? What? What? That's why I always try to go, and I know I go on and on, but do you understand the why now? The reasoning. Because you were scared when this thing started running out of steam that the up push might be over and we're going down. Here comes the sellers, 600%, and nope, they got rejected. Get a sniper trade to go up. Okay, I'm in. Right? See that? But if this pullback did not have HD in it, would I be wanting to go long right here at all? No. Okay. Get it? Some light bulbs there. Mark, did that answer your question? I think you already had the answer like halfway through that scenario. I think you're like, ah, got it. Right. Okay. It's just a market read. But do you get it now? You're like, okay, yeah, I heard y'all say those were the rules, but I had no idea what the hell y'all meant by that. Now you can see it. This is what's called reading the market, right, Christopher? Is seeing those kind of things there of why I would do this, why I wouldn't do this, and how to put all the pieces together and not just look at these numbers. Well, this number was higher or lower than this one, so I pressed buy. Why? What's the why behind it? Okay. I always like to focus on those whys because once you understand the why, you can read any of these markets. Cool. Okay. We're just a little over an hour here. I think I got most of your questions answered, and if I didn't, I think that last little piece did it. Good? Helpful? Something you think you can use tomorrow, use day to day? So keep in mind, go back and watch the video recordings if you have to. Standard divergence, trend, when is it coming to an end? Getting exhausted. Hidden divergence, how strong of a pullback do we have on the bow for it to continue and keep going? But must be a trend, must have a previous pullback in that trend to compare to. And there you go. Brian, you need better illustrations. An illustration that pits an HD against a non-HD. We went through a couple of those, showing which one was and wasn't and why. Like this one here we went through, why it was not an HD. Even though it was a lot more volume, it went too far. It's very simple. Either it has more volume, but it pulled back further, or it has less volume and didn't pull back as much. Those are the things that would not be HD. Okay? Rocket science. All right. Roger says, why is it called hidden divergence? It's just a term in the industry of what they call it. It's just hidden divergence. You know, there's probably a better name for it, you know. One's you could call it, um, you know, exhaustion, trend exhaustion, or trend ending divergence and trend continuing divergence. So, all right, guys. Once again, I appreciate it. Do me a quick favor, pop this in your Skype rooms. If you hop on Facebook for me on our Facebook pages, just comment about the webinar if it helped you out, recommend it, refer others to it, especially for those of you that are like, oh, light bulbs going off. Help us get some people out there watching the recordings. Talk about it in the elite room tomorrow if you could, recommending people to check out the recording. Hope it helped. Use it in your trading. Hop in the elite room tomorrow morning. Keep an eye out this weekend. I'll get those Labor Day specials out Friday or Saturday, but I'll get them all out there for you. Okay. All right, guys. Thank you so much. Seriously, if you could please hop in the rooms, hop on Facebook, especially right now. Please on Facebook, especially our groups. Mention the webinar. Encourage people to check out the recording. If you can log off the webinar right now and hop on Facebook right now, I'd love to see 10, 15, 20 comments on there. Let's get it out there. Can you do that for me? Can you pop on over and then mention it in the room tomorrow as well? Because I've seen this a lot lately. A lot of confusion on divergence and hidden divergence. So really hoped it will. Helped. All right, guys. Thank you so much. David, Beth, Mario, everybody. Thank you. Appreciate that. All right, guys. We'll see y'all tomorrow. Have a good one. I'm going to be going over to Facebook in a few minutes. Y'all better get on it.